historically crypto recoveries are V-shaped. Crypto investors have been frustrated, as you correctly point out. Consensus in Hong Kong, the mood is horrible because past crypto winters, which are bear markets, happen when the stock market's declining. So people don't feel bad about like, oh, I'm stuck in crypto, but like everything stinks. But actually stocks have been okay and gold has been really good. So now people have like this egg on their face saying, am I a dunce for staying in crypto when I could have just been buying gold? Central banks are easing, should be good for crypto. Geopolitical uncertainty should be good for crypto. Dollar weakness or yen weakness should be good for crypto. Until crypto prices start to bottom and recover, I think crypto doesn't have reflexivity.
Lee begins by revisiting the October price shock in crypto, a deleveraging event that, by his assessment, exceeded the magnitude of November 2022's FTX collapse. Historically, crypto recoveries are V-shaped. After major liquidation cascades, it typically takes 6 to 8 weeks for price reflexivity to reassert itself. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
You know, speaking of gold, Tom, a lot of crypto bros, sisters, people, I mean, even at Consensus, it felt quiet. Maybe it's really the crypto headlines that I've been reading about. And in the event yesterday, it just felt more contained and quiet. Perhaps it's really the FOMO over gold and really disappointing price action in crypto space. So my first question, your end of January calls for Bitcoin and Ethereum, they were pretty bullish, but it didn't really materialize.
Yeah.
What were you looking at? What were some of the factors that you thought would drive up Bitcoin and Ethereum by the end of January? Why January?
Crypto had a price shock in October. And that was, in terms of deleveraging, bigger than November 2022 when FTX failed. That was, in 2022, the bottom for crypto. Crypto was beginning to recover from that carnage because it takes about 6 to 8 weeks. And historically, crypto recoveries are V-shaped. But I think a couple things happened that really hurt us in January. Number one was, in October 10th, we had a tweet about China that over the weekend caused huge ripple effects. Well, we had a Greenland tweet that triggered another cascade of liquidations. So crypto basically got chopped at the knees again. The second is that crypto investors have been frustrated, as you correctly point out. Consensus in Hong Kong, the mood is horrible because past crypto winters, which are bear markets, happen when the stock market's declining. So people don't feel bad about like, oh, I'm stuck in crypto, but like everything stinks. But actually stocks have been okay and gold has been really good. So now people have like this egg on their face saying, am I a dunce for staying in crypto when I could have just been buying gold? Well, that is playing into the psychology because gold started to do really well in January. So I think FOMO plus the fact that there's now double negative leverage effects because of Greenland means crypto is, it looks really like it's bottoming because the fundamental story of crypto is quite positive.
Then you are spending some time very early this morning with our U.S. colleagues talking about this U.S. jobs data. Do you think it perhaps changes your thinking in any way, or the revisions matter more?
I mean, a little bit of both. You know, I think the Fed Chair Powell says he subtracts $65,000 a month from any jobs report because he knows the revisions are negative. But I think that it's not lost on the Fed that AI is sort of wreaking havoc across software now. And that means the jobs losses are soon to follow. So I think the stock market isn't going to care about the labor reports in their minds, because in the back of their minds they're going to say, well, how much of these are going to be lost in the future due to AI?
Do you think Kevin Warsh and his Fed would care more about what AI is doing to the jobs picture and how inflation is sort of behaving at the moment. What are your expectations? Because at the start, I mean, right upon the announcement of his nomination, market was acting like he's a hawk.
Correct.
You don't agree with that market reaction?
Yeah, I mean, I think the market reaction, and I think they're rethinking it, didn't make sense because Trump wouldn't appoint a hawk. But it looks like Fed, the new Fed, Warsh, actually does want lower rates but a smaller balance sheet. But to me, in 2026, the overarching story is that if jobs are shrinking and AI is wreaking havoc across sectors, remember, software used to eat the world, right? It's a $450 billion sector. Now that's getting eaten by AI. If software shrinks, that's deflation. So I think the inflation picture, and AI is showing it's actually disinflationary. And we get a CPI report in January from this Friday, but core CPI year over year might drop to 2.52. That's the average from 2017 to 2019. We're back to pre-COVID inflation. So I think we have a dovish Fed coming, and then Fed funds rates were like 1.5, 2.0 back then. So I think there's a lot of room to cut rates. So I think it's a disinflationary environment.
And when the Fed stays dovish for those reasons that you're just laying out and even go for a couple of cuts later this year, does the market react to that positively? Because it matters why. If AI is eating jobs and AI is affecting software in a negative way, is that a good thing for the markets?
Yeah, it is. But it's creating winners and losers. That's what the stock market's trying to figure out. Last year, they were buying the Mag 7. Those are like the armies. This year, people are buying energy, industrials, commodities, power generation, chips. Those are the bullet makers. So they're still buying AI, but they're buying the guys that receive the CapEx. I think software may be a net loser, but that they're a distributional consequence of AI.
When I know that your outlook for this year is that we're going to do okay in the first half, and then there could be some bear market like a drawdown and then pick back up. So number one, are you sticking to that outlook?
Yes.
And number two, when that does happen on the U.S. market, how does that affect international markets? I feel like you're spending more time paying attention to what's going on international markets. Does that have a sort of simple spillover effect to the rest of the world and to Asia, or does international outperform the U.S. again in 2026?
I think there's a scenario where the drawdown, we think it's a three-phase market. So let's say we get into the period where the U.S. stock market declines 10, 15, or 20%. A lot of that is probably a rotation out of Mag 7. So out of the armies and plowing into industrials, financials, everything else. But that's Mag 7 is 55% of the market, right? That's a big complex. That's probably bullish for non-U.S. because non-U.S. country indices are industrials, materials, everything but tech. So I think it actually is bullish for non-U.S.
Gold's outperformance has compounded crypto frustration. Retail traders, including those frequenting high-risk communities like Wall Street bets, have increasingly gravitated toward precious metals, often using leverage and zero-day option strategies. Lee's interpretation is telling. Macro conditions that should theoretically benefit crypto, central bank easing, geopolitical instability, dollar softness, have instead benefited gold. Investors have chosen alternative expressions of macro anxiety.
For the last 15 years, crypto was evangelists and devoted people in the community, and a lot of programmers, and not really an institutional presence. And of course, all that's changing, because as you look at the next 10 years, it's really about blockchain and being adopted by Wall Street to build stable coins, and it's about AI agents running on the blockchain, and it's a lot about creators and others blurring whatever's money. But because we're in that transition, crypto still relies on FOMO and price and a lot of traders to use leverage to buy and get prices higher. October 10th wiped out a huge part of the system. You know, a lot of market makers went out of business. The balance sheets of many crypto exchanges got crippled, and you know, multi-million number of accounts got wiped out. So I think the industry really delevered on October 10th.
Leverage is a dangerous thing. So what's it going to take for us to get back on track? What catalysts do you see that people maybe aren't paying attention to? When are we going to stop lagging global liquidity?
Yeah, it's a great question because central banks are easing, should be good for crypto. Geopolitical uncertainty should be good for crypto. Dollar weakness or yen weakness should be good for crypto, but it hasn't been. And I think part of it is people have chosen other ways to express that view, especially a lot of retail traders. I think they're starting to use precious metals for that. And of course, as you know, retail traders like to use things with leverage, zero-day trading, etc. And it's so evident because if you go to Wall Street Bets, the two most talked about tickers are silver and gold. Like, they're not talking about anything else. So until crypto prices start to bottom and recover, I think crypto doesn't have reflexivity.
What signals are you looking for to mark that bottom?
I think we're close, Frank. Because on the one hand, okay, there's a huge camp of people that say we're in the 4-year cycle.
Yep.
And so it's going to take a year. And look, the timing kind of lines up that we're in a 4-year cycle. However, on-chain activity is arguing against the 4-year cycle because usually on-chain activity starts to fall. Like active addresses, wallets are falling. But look at Ethereum. When you look at June, when Ethereum was exactly at this price, active addresses is up like 115%. Daily transactions are up 77%. Total value locked on in terms of real-world assets is up like 50%.
Yep, it's up 23 billion the past 30 days.
Yeah, so this is the opposite of what I would consider to be a crypto winter.
Well, how much is quantum risk playing a role in this? You mentioned it, or at least it was discussed on your panel. We saw in Galaxy's earnings report that they had a client partially scale back a position by 9 billion because of quantum risk, at least partially. How big of a risk is that?
Well, quantum is part of the conversation. So, like, are people reacting to it? Yes, because it's come up in so many of my conversations with institutional investors, and that makes them uneasy. So it is affecting the price. Is quantum actually a risk to Bitcoin at the moment? That's a good question. I think it's unknown because today's quantum computers can't break Bitcoin encryption. It's the anticipation of the progress of quantum that will allow them to break the encryption, especially on a lot of the legacy Bitcoin wallets. I think the other blockchains are okay because Ethereum upgrades every 6 months, so you can make quantum resistant the blockchain and wallets. But so it is an issue. I think Bitcoin probably needs to address it sort of specifically, and then once people believe quantum resistance is feasible, like some implementation plan, then it won't really hurt Bitcoin. Ethereum is really the largest smart contract blockchain. And so the Lindy effect says, look, Solana is actually good, but it's much, much smaller. And as you know, Wall Street may try to work with other blockchains, that suit Wall Street's sort of focus. But at the end of the day, if we think about this decentralized computing, smart contracts recording everything, AI, stable coins running, there's only Ethereum.
How Lindy do you think is Ethereum? I mean, with a track record of 10 years, right? You look at something like VHS, which had 20 years as the main mode of video, for instance.
Yeah. Well, it's had 100% uptime, which means it's actually proven to be really reliable. Will, in the next 10 years, is there going to be a competitor to Ethereum? It would have to be something that's not a blockchain. But the VHS analogy is interesting, but that I think is more analogous to like traditional finance. You know, that Wall Street is probably VHS, you know?
I think that's right. So that kind of makes me think of something you talked about on stage, which is the extent to which at the upper echelons, the top brass of these banks, they don't necessarily have the same buy-in as the folks down here at Lincoln Center. Is that an opportunity? I mean, because a lot of people are maybe thinking we're not so early if we're having events like this with folks from the likes of JP Morgan and Morgan Stanley, but the top brass maybe still is that opportunity zone.
Yeah, that's true. I mean, this is early days. I kind of mentioned it, reminded me of mobile. Like, mobile wasn't really mainstream until Apple made the world take it seriously. Up until that point, cellular was kind of an industry that many thought wouldn't survive long distance and local phone companies one day deciding to eradicate it. And I think that's how people view crypto. Or one day Wall Street will wipe it off the face of the earth. And I think many people believe that. But if that view is not correct, then there's still a lot of upside in crypto.
Tom Lee's framework is neither blindly bullish nor structurally bearish. It is transitional. Crypto has endured a leverage purge that masks improving fundamentals. AI is simultaneously disruptive and disinflationary. The Federal Reserve may soon pivot more decisively than markets expect. Equity leadership is rotating. Global opportunity is broadening.